Give us some of your insights of what markets and investors should be watching as we continue to see these global central banks moving towards normalization and tightening.
Well, great to be with you, Shery. Well, first of all, the point I would make is that this time is different. What's different this time around? It's the higher inflation and the tight labor markets, and that we still have upside inflation risks because of energy prices, higher wages, also housing prices. So we have revised our outlook for the Fed. We have 5 Fed hikes this year and 2 more in the first quarter of 2023. So that's 7 Fed hikes by the end of the first quarter of 2023. And I think that the normalization process for the balance sheet will start in July. So this is the end of quantitative easing. Rate hikes in March seem to be a given. And there's still a lot that we have to learn about balance sheet normalization. There aren't a lot of precedents for this, but we are forecasting that the Fed is set to shed about $1.2 trillion in longer duration assets by the end of 2023. So we've moved up the 10-year Treasury yield forecast to 2.35%. But it's not over there. We think that the Bank of England will be hiking rates. I don't see the ECB moving until the first quarter of 2023. But even in the emerging markets, even with the hiking that began a year ago, that began middle of last year, we still have 14 out of 23 emerging market central banks hiking rates as well.
And yet you continue to think that EM equities will outperform developing market equities. Why is that? Is that because of their preemptive tightening?
Well, part of it's the preemptive tightening. Part of it is the massive underperformance last year. And, equity markets sold off across the board, but EM did outperform. Now, part of it is also China. China was a very poor performer last year, but China is desynchronized from the rest of the global economy. It's the only one that's really easing right now. And we don't see them really removing the fiscal support. The story in China has been all about stability this year. I see more credit easing than interest rate policy, but we still have one more triple R cut there. So part of this is the China story. Part of it is that emerging markets started much earlier. And part of it is that they have more of a buffer as well for some of the countries that did start early on last summer raising rates.
What part of the story does the US dollar play in this as well? Because, yes, EM does look pretty attractive in terms of valuations compared to US equities, but we do have a strengthening US dollar. How do you balance that?
Well, we've also had a lot of EM FX weakness that has occurred during the course of the pandemic as well. So I do think that, when we take a look at the dollar, we're looking at a lot of the growth differentials. And we're probably going to see the weakest quarter for growth around Omicron in these December, January numbers. We're thinking there will be more of a rebound in the second quarter of the year, in the U.S., also in China. But we're really looking at more of a range-bound dollar here. I don't see it doing a huge move, but for EMFX, the key point I would make is that we've already seen a lot of this depreciation. We're seeing valuations that are quite different than we've seen at other points when the Fed has been hiking rates.
Well, of course, we've had China, Hong Kong, a number of other Asian markets shut this week for the Lunar New Year holiday, and we've seen some pretty impressive gains for US equities and those other markets that have been open. What sort of catch-up trade do you anticipate on Monday when the rest of Asia opens up again?
Well, I do think that focus will be on China. It will be on the policy measures that they may be coming out with as well, easing measures, what they're doing at the sectoral level as well. But I think that, you could still continue to see that we have to live with some of this market volatility, as the new normal. I think we are in a period where we're seeing shorter cycles and greater volatility. And that's going to stay with us as we have central banks, hiking rates. So I think that China, though, will stand out for just having more of an ability to put in some, easing measures that will cushion this. And I really would look at their common prosperity, agenda and the sectors that they have been emphasizing, domestic consumption, local brands, whereas they've been very clear on some of the large internet platforms, some of the community group chats, things that don't have that clear of an economic value, that's going to be de-emphasized. So I think those themes are going to continue as we get past the Lunar New Year.